Is it time to short the market? That's a very common question I've been getting lately, because if you look at the S&P 500, it is running into a very strong level of resistance where there's a confluence of both the 200 moving average acting as a strong resistance and this dreaded trend line that has formed during this bear market. So again, if you take a look at the charts, you can see ever since the bear market started, we've got this very strong trend line as well as that 200 moving average. And we know that 200 moving average is a very strong resistance, but once the market can close above the 200 and the 200 slopes up, that really is a very strong bullish signal. That has not happened yet. So what happened in the last few days is you can see that the S&P did close above the 200, but it's not a big deal. So what if it closes above the 200? The 200 has to slope up and the 200 is still sloping down. And just 3 days later, the S&P now closes back below the 200 moving average. So that's freaking a lot of people out, because they're saying, hey, I've seen this movie before and I've seen what happens. That every time it hits the resistance, it comes down, hits the resistance, comes down, hits that resistance, it is definitely coming down. Now remember that there are no absolutes in the market. The market will break above that resistance eventually and start a bull run. But will it happen this time, or will it happen further down the road? Again, no one can predict for 100% certainty. But let's look at what's happening right now. So again, the question would be, is it now time to short the market as a preemptive measure? Before I answer that question, do understand that when I say short the market or sell the market, it doesn't mean that I'm selling all my stocks. No. So my stock portfolio that consists of great businesses, I'm not selling shit. I'm holding on to these companies because in the long run, they will always go up. But at the same time, if I see the market's going down, I will simultaneously short the market using options in order to hedge my long-term investments. So in this video, I'll show you exactly how I hedge my long-term investments by shorting the market. Now, before I actually short the market, I want to be sure that it is going down. Because many times in the market, what you find is that we have false breakouts and false breakdowns, also known as bear traps and bull traps. So for example, you could call this a bull trap, where the market closes above the 200 moving average. People get excited, yeah, it's above the 200, and they start buying, and the next day it goes back down. That's a bull trap. Well, bull traps happen all the time. But at the same time, it could also be a bear trap, where now the market closes below the 200 moving average. People say, oh, bearish, they short the market. The next day it closes up, flies to the moon, and they all get screwed. So you got to really be careful about avoiding these bull and bear traps. Now again, you can't avoid them 100%, but there are things you can do to only enter when the probabilities are very high that it is going to go in your direction. So currently, if you take a look, you can see, let me kind of like go closer into this chart over here. So yeah, you can see as of yesterday, we closed below the 200 moving average. But if you take a look at this, you can see you can draw a counter trend line over here. We call this a counter trend line support level. And right now, it is still above this counter trend line support, which means that it could still, today, you never know, or the next couple of days, it could still close back above that 200 moving average and move higher again. So I wouldn't say that now it's 100% certainty it's going down. I'm watching this trend line support. If I see that the S&P breaks and closes below this trend line support, I would then be more convinced to take a short position on the S&P 500. So I'm watching very closely to see if it breaks and closes today or the next couple of days. So if the S&P indeed breaks that trendline support today or next few days, how could we take a short position with low risk and high returns? So one way is to use options, to use put options. So my favorite approach is using what is known as a put option spread, where I buy put options at the current price and I sell put options at my target price. So by using a spread, it lowers the cost of the trade and lowers the risk of the trade as well. So I'm going to show you how I'll do that. So if the S&P 500 were to break the support right now, how would I use options to short it? So let me give you an example using the S&P ETF options, which is the SPY. So the first thing I'll do is I'll go on and I'll take a look at the option chain. All right, and of course the first question in options would be, how do you select the date to expiration? Like how many days to expiration? So it depends on what's my time frame. So let me give you an example. So looking at the SPY right now, let's imagine I like to short it right now, take a short position. So the current price is about $3.99. That's where we are right now. So the first question is, where's your target? Where do you think it's going to fall to? So the first target would be 375, because that's where we have a level of support. So from the current level, which is about 400, all the way down to 375, how many points is that? That's about 25 points. A 25-point drop in the S&P would be the downside target, at least for the intermediate term. So I go on to my option chain, and knowing that it's going to drop 25 points, I look for 25 over here. So I'm scrolling down, and there we are, 25 points. Now, usually I would go for a bit less to give a bit of buffer. So I'm going to go for 22 points. So what does this mean? This means that based on current volatility, it will take about 38 days for the SPY to drop 22 points or go up 22 points, right? It's a volatility measure. So that tells me that I will use the 38-day expiration for the options. So I'm going to open this up, and I'm going to look at put options. So first I have to decide what's the strike price, which I'm going to buy the put options at, and then the strike price to sell the put options, creating an options spread. So usually I buy the put options slightly near or out of the money, which is slightly at or below the current market price. So the current market price, again, is about $3.99. So I'm going to buy the puts at about I could buy the puts at about, $3.99, right? So I'm going to buy the $3.99 puts, okay? I'm going to buy these puts. Now, if I buy these puts, how much money would it cost me? It would cost me $10.39 per share. So times 100 shares per contract, that's going to be about $1,039, which is expensive. So what I like to do is, I like to, at the same time, sell a put option at my target price. So recall that my target price is roughly 375, which is where I think the S&P will drop to, right? So at 399, I'm going to buy, I'm going to go long, and 375, I'm going to sell a put option over here. So by selling this put option, I collect $3.42, and with this money, it will help to pay for the put option of $10.39. So that offsets my cost slightly. So this is what I do. I'll go to 399, and I'll execute a buy vertical spread. So what that means is I'm going to buy the 399 and sell the 375, which I showed you earlier on. So go 375. Boom. Okay, there we are. So how much would this trade cost now? Instead of paying $10 initially, if I just buy the put option, now because I buy a put and I sell a put to pay for the first put, right? Net, I only pay $6.97 per share. So multiplied by 100 shares per contract, the cost of the trade is $697 to enter this one contract. So what's my max risk? Now, when you enter a bear put spread option, the maximum risk is the price you pay. So the maximum risk or the maximum loss, if I'm wrong, if the market goes up, doesn't go down, I lose $697. But if the market goes down to my target price of $375, what's my profit? My maximum profit is $1,700. So in other words, I'm risking $697 to make $1,007. Now, is that a good risk to reward ratio? In trading, you always want to ensure that you risk $1 to make more than $1. So if you take 1,007 divide by 697, roughly, I'm risking $1 to make $2.40. Now that's a good trade, right? So again, remember that in trading, we can't be right all the time. We can't win 100% of the time. But as long as we make more when we are right and we lose less when we are wrong, we will be very, very profitable as a trader. So again, if you take a look at these statistics, right? So imagine if theoretically you take 100 trades, and again, you never know which trades are going to win, which trades are going to lose. And I tell people that even at a 50% win rate, let's say you win 50 trades and you lose 50 trades, you will still make a fortune. Why? Because, for example, in this case, if this happens to be a losing trade, right? And during losing trades, I lose, let's say, $1. I lose $1. So that's a total of minus $50 over 100 trades, right? But those trades I win $2 per trade because of the risk to reward ratio. So for the winning trades, I get $100. So $100 minus $50, my net profit is $50. So this is the secret of profitable trading. Remember, profitable trading doesn't mean that you win all the time. Doesn't mean that you can predict that this trade will be a win. You can't. This trade could be a loss. But profitable trading means that if you keep trading consistently, taking trades with a good risk to reward ratio, following price action, you will always make money over time. It's kind of like a business, right? This is like the sales. This is minus cost. You always make a good profit. So I think that this trade, if you ask me, is a good trade to take. Again, once I confirm a break of that trendline support. Now, if you take a look at the profit and loss statement, it looks something like this. So again, you can see this is the current price of the SPY, which is $3.99. And again, if it drops to 375, which is my target price, let me go to 375. Yep, 375. That's my target price. You can see that I will make a maximum profit of about $1,700, okay, at expiration, when the options expire. But if the market goes up, if the market doesn't go down, but the market breaks that trendline resistance, the market goes up, then what's the most I can lose? The most I can lose at expiration, which would be the green line, I would lose $697, right? So I lose $697 and I stand to make, again, $1,700. That's a good risk-reward ratio. Now, in reality, when I'm trading, and if I'm wrong and the market goes up, will I lose this entire premium? No, I won't. Remember, I will only lose this if I let the trade expire worthless. But in reality, if the market goes up, I could exit early. So if I exit early before the purple line, notice that as time passes, the purple line is the profit and loss. The purple line will only hit the green line. Notice I'm moving this at the expiration date, which is on the 13th of January, which is at about 38 days, right? Only in 38 days will I lose all my money if the price goes up. So once I see the price going up and not going down, I will cut loss early. All right. And for example, if I cut loss on the 20th of December, you can see that even if the market goes up to, let's say, 420, which confirms a bull market, and I get out, instead of losing everything, I would lose about $500, somewhere there. So I'll lose like $500 instead of $697, right? So I lose $500, but if the market crashes and I make $1,007, hey, that's a good, again, risk to reward ratio. I'm risking $500 to make $1,007. That is like risking $1 to make $3. If I keep taking trades like that, I make a fortune. And that's the key to being a very profitable trader. Now, the other way to make money if the market crashes is to buy or to go long on the VIX index. Now, the VIX is known as the volatility index, which is known as the fear index. So notice that every time the market crashes, the VIX goes up. Market crashes, the VIX goes up. So if the market crashes, the VIX will go up as well. Okay? So another thing to do is to buy call options or to buy call option spreads on this volatility index. Now, again, people are looking at the VIX and they are seeing a very strong support level here. And again, every time it hits the support, bounces up, hits the support, bounces up, hits the support, looks like it's going to bounce up. Again, there are no guarantees. It's just a probability. So in fact, the VIX is also suggesting that the market looks poised to take a dump. But again, we have to wait for confirmation. So I'm going to show you right now how I would buy call options on the VIX. Now, bear in mind that you can't trade the VIX. You can't. You can only trade the VIX futures, and you can only buy options on the VIX futures. Now, before I start, a bit of a disclaimer. I've already entered some initial call options on the VIX futures. In fact, I posted it on my private community, the UIP community. You can see over here. This was on the 2nd of December. I said that VIX has retraced to support. I took a small initial position to go long on the VIX futures, entering a bull call spread, and this was the trade I entered. Right, so disclaimer, I have entered a small position, but I'll be adding more to my positions if I see the market starting to break down. But let me show you how I would do this. So first, let me go on to the VIX. Now, this is the VIX. So there we are. This is the VIX of volatility index. You can see a strong support level there. Right, so again, hits the support, goes up, hits the support, goes up, hits the support. Could it be going up? Maybe, right? It's a probability. So again, we are gonna buy call options on the VIX futures. Now again, if you just buy a call option, it's gonna be very expensive. So I like to buy a call option here. I gotta pay a premium, but at the same time, I will sell a call option here, because when I sell a call option, I'll collect money to pay for the call option I buy, creating a bull call spread that lowers the cost and lowers the risk. Now again, bear in mind that when we trade options, we're trading options on the VIX futures, not the VIX itself. That's what people get confused about. So this is how it's done. So I'm going to go to my trade tab over here. And again, the first thing is to select a date to expiration. Now VIX is a bit of a unique animal, okay? So usually when I trade the VIX, I take a shorter time frame because VIX tends to move faster. And in a bull call spread, your profit is maximized at expiration. So if you take a long date to expiration, your profits will not be maximized till many days later. So I want quick profits now, so I'm taking a shorter expiration. So I'm going to take, for example, the 14-day expiration. Options will expire in 14 days where I'll maximize my profits. Or you could even take a shorter expiration, but let's just take 14 days. I'm going to open this up, and this time I'm going to look at the call options. So first I'm going to buy a call option roughly at a delta of below 50 or 50 delta, which is what we call at the money, right? So over here you can see I'm going to buy the 50 delta call options, which is at a strike price of 22 strike price. 22 strike price. So we're going to buy this call option. It's going to cost me $1.48. Ooh, expensive, right? So at the same time, I'm going to sell a call option at the 28 strike price. Let me say, why 28? Okay, because I'm just kind of like guessing that if the market crashes, the VIX will go to at least 28 or higher. Okay, now you can put higher as well, but I'm just going to put 28. So if I sell the call option at 28, I collect 42 cents in premium, and I use the 42 cents to pay for part of this call option that will lower my cost and lower my risk. Pretty smart. Yeah. Okay. So this is how I set up the trade. I will buy this sucker. To buy a vertical spread. There we go. So I'm going to buy the 22 and sell the 28. Here you go. And how much would this trade cost me? Well, pretty cheap. It's going to cost me $1.07 per share times 100 shares per contract. It's going to cost me $107 per contract. Yeah. So that means the worst that can happen, if the market doesn't crash, I lose $107. Yeah. But if the market crashes and the VIX goes up, how much do I make? I will make a maximum profit of $493. That's a pretty good deal, right? So essentially, I'm risking $100 to make almost $500, right? I'm risking $1 to make $4.90. Now, is that a good risk to reward ratio? Yes. And again, like I keep saying, when I take these trades, I don't have to be right all the time. I just have to be right half the time. Or even if I'm right less than half the time, I still make a fortune, because when I'm wrong, I lose $1. When I'm right, I could make $4 to $5. Now, of course, it doesn't mean that I'll definitely make $493, right? I may take profit early, so I may make maybe $200 or $300, right? But the point is that we want to take these asymmetrical trades where, again, small risk, huge rewards. And we just do this consistently. And again, the key to becoming profitable in trading is not to predict 100%, but is to control your risk to reward ratios. So again, this would be one trade, right? Again, if you see right now, the VIX is at about 20.75. Okay, so if the market crashes and this guy goes up to, about 28, somewhere there, or if it goes even higher, could make a pretty good profit that would again hedge your longer term investments. So this is just a short video to show you how you can actually use options to hedge your longer term investments. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.